fear confronting the market, the economy and the fisc today is the health of the banking system and the extent of bad loans. Declared bad loans or non-performing loans are at 3 lakh crore rupees or 5.1% of total loans. But brokerages like Credit Suisse always feared that loans 3 times that number can't be repaid. While the counting of bad loans goes on, in the past 8 weeks, a series of steps have been taken to mend the problem. 1. The Reserve Bank has asked banks to reclassify more dicey loans as NPLs. 2. RBI has empowered banks to convert debt to equity and take over defaulting companies and sell them to new promoters. 3. The government is setting up a stressed asset fund out of its National Investment Fund, the NIIF, which will provide equity capital to projects which are worthwhile but starved of cash. 4. Companies like KKR are also setting up special situation funds that are ready to buy stakes in distressed companies and turn them around. 5. Government is trying hard to get the new bankruptcy law passed in the upcoming session of Parliament. The question now is, can all these developments lead to the start of a de-stressing cycle? Some say the fear of the NPL tag will make promoters more willing to bring money or sell assets at realistic prices. Others say, on the contrary, promoters can non-co-opt. Some say with RBI pushing banks to mark loans as NPLs, banks will be willing to sell down their debt for its true worth. Others say bankers will always be wary of selling loans cheap. 3. Optimists say that the new category of special situation funds can buy beleaguered companies from banks, pump in equity and turn them profitable. But pessimists say these funds will ask for such big haircuts in loans that banks won't bite. So, are we at the start of a de-stressing cycle? That's the question. Now let me get my guests in. Sanjay Nair, CEO of KKR India, Nikhil Shah, Managing Director of Alvarez and Marsal, the company that specializes in managing bankrupt companies and turning them around, and Mr. Pradeep Kumar, former Managing Director of State Bank of India. Gentlemen, welcome. Sanjay, before I ask you about the Special Situation Fund, I'm just asking you whether the incentives or disincentives have been created in the system to bring people to the table and sell. Do you get that sense? Promoters back to the wall, bankers, okay, provided for, so more willing to sell.
Yeah, I think in a nutshell, I think the conditions are much better today from all the stakeholders to get on with this de-stressing cycle. You already covered all the reasons why, but some specific actions being taken by the RBI, a few cases of successful sales to ARCs, although we don't know what the realization value is, and some of the management experts coming in to turn things around. And I think also the fact that government is giving a lot of comfort to the public sector banks that, look, there's an equity gap, we will try and take care of that. So conditions are right.
Has Marsal and Alvarez been involved in other countries where the process is successful?
Absolutely. So we handled the Lehman Brothers, which was the largest bankruptcy in the world. When they filed, it was about $650 billion in liabilities. The estimated recoveries to creditors in that case was 14 cents on the dollar when we took over management of the company. And through the bankruptcy proceedings and subsequently, that recovery has increased to 3 times to about 45 cents on the dollar for creditors. So there was a huge value creation that was...
That's a marquee and a big case, say in European countries.
So in markets like the UK as well, they have a very, UK and Ireland, I would say, who went through the financial crisis in 2008 as well. They took the hits up front as well in terms of the probability impact of writing down these loans. And because they did that, there's a mindset of actually, now that we've taken this, what can we do actually to actually revive these companies or actually move on and start lending to companies that actually do deserve those loans. Okay. And in other markets, of course, like in Italy, for example, they haven't actually taken those hits. And in India as well, I would say that I think we believe, like Sanjay does, that 2016 probably is going to be that year, given what the RBI and other stakeholders are saying.
Okay, Sanjay, KKR would also have several cross-country examples where probably things have been resolved. What can we learn? And
I think first and foremost is you got to recognize the problem early enough. So I think, as he mentioned, that if you recognize it too late, either the conditions of the company and the corporate become so bad that you just lose a lot of equity value, and then there's no point throwing good money after bad. So number one, that. I think we are at a stage we're already getting late. I would say the optionality that people thought, oh, GDP will grow and things will get like recovered, with the tightening of the rules and shutting of the options even by the Reserve Bank, I think more and more you're finding that you have to reduce the optionality and just force them to take the hit. I think we're already late, but you know, there is still a hope, because you still have GDP growth and you still have a lot of recovery potential. And that is why it is critical that recognize the problem now, and we'll talk about the models of recovery, but the idea is you can create equity value from here on. A little bit of help we all need with the help of GDP and some policy changes, but I think we can get some equity value back, which then can be distributed to everybody, so we can.
I agree. Probably steel is an extreme example, because the world is in a hole as far as steel is concerned. But non-steel loans are also perhaps about 6 lakh crore of stressed non-steel loans. What do you think should be the best course as of now for a bank and for a promoter?
I would say that if, well, one is the ARC route. I think there are many routes available, right? ARC is a good vehicle, constitutionally empowered to do a few things. But I think the best way to do this is for 3 stakeholders to work together: the management and the promoters, the bank, and the guys who bring in the funds, and then the turnaround people, which is the same thing. Let's just treat this as the 3rd stakeholder. I think banks have to be flexible to accept what the right value today is for the asset, be flexible on how much haircut they can take on the debt. I think the funds have to bring in all kinds of equity, capital structure, a bit of equity, a bit of super senior structures, a bit of pari passu debt. Revive the companies, put in the minimal capex, put in some working capital, and get them started again. And obviously the turnaround people and the management people have to make sure that we can install the right management or work with existing management. There's no other model. And then of course the third one is you take the asset, you strip it, and you sell it. Okay. I think we are in the camp that we are not at that stage right now. As an economy, if we can begin to act now, I think you'll see the multiplication power of the funds that come in is huge. So even if the 3 lakh problem we cannot solve, the leverage that this brings in, leverage as in leverage of multiplier effect is quite significant if we work together.
Okay. Well, I'll come to your best guess of how many can be resolved in a year or two. But Mr. Pradeep Kumar, from the banker's point of view, do you think there will be greater willingness now to probably take a hit on the loan value? In the ARC, you don't really take a hit because, 15 rupees comes in terms of cash and 85 rupees comes to you in terms of security receipts. So on the book, you're not taking a hit. But in this case, you may want to take that hit, but give it to probably the stressed asset fund or to another promoter or to a KKR.
Yeah, the first thing is when you sell to ARC, you don't get 100. You get 15% of the actual value.
Exactly.
And 85% of it in the other securities. The rest, of course, has to be written off from your books. Yes, now there are multiple options available. I mean, if the new investors are willing to come in, either through the SDR route or through any other route, then through any other investments, I mean, for special situations fund, like what Sanjay has set up, or the NIF, I think bankers will always be willing. The banks will always look at to get the maximum value for its debt. I think that is fair enough. Of course, there will be haircuts. Maybe we'll have to structure it that tomorrow if the company turns around and the equity gains in value, the banks also will get some upside from that. So some sort of convertibles also will have to be, maybe loan will have to be converted into a sort of a preference, cumulative preference shares or something like that. Has to be, some structures have to be thought out. I think banks will be willing. And of course, as everybody says, yes, if it is already recognized as the NPA, I think there will be greater willingness on the part of the bank.
Okay. Well, just hold on to that thought. I have to take a break at this juncture. We are back with more questions for our guests, Pradeep Kumar, Sanjay Nair, and Nikhil Shah.